I need to warn you about something that most investors are completely ignoring, something that has the potential to devastate portfolios over the next 12 to 24 months. And it is not what you think. It is not inflation. It is not a recession. It is not China or geopolitics or any of the things the financial media obsesses over every day. It is the Federal Reserve. And specifically, it is a mistake they're making right now that could trigger one of the most painful market corrections we've seen in years. I've been managing money for over 3 decades. I've watched the Fed make mistakes before. I watched them keep rates too low for too long in the early 2000s, fueling the housing bubble that nearly destroyed the financial system. I watched them wait too long to raise rates after the financial crisis, creating distortions that are still working through the economy. And I made $7 billion in 2009 by betting against the consensus when the Fed's actions created the opportunity of a lifetime. I understand the Fed. I understand how they think. I understand their models, their biases, their institutional constraints. And right now, I am seeing a setup that has disaster written all over it. Today, I am going to explain exactly what mistake the Fed is making, why it is going to hurt your portfolio, and most importantly, what you can do to protect yourself before it is too late. Let me start by explaining how we got here, because context matters. In 2020, when the pandemic hit, the Fed did what central banks always do in a crisis. They flooded the system with money, they cut interest rates to zero, they bought trillions of dollars in bonds, they did everything they could to prevent an economic collapse. And it worked. The economy recovered faster than almost anyone expected. Stock markets soared. Real estate prices exploded. Unemployment dropped to historic lows. By many measures, the policy response was a success. But there was a cost. All that money printing created inflation. Not immediately, but eventually. By 2021, prices were rising faster than they had in 40 years. Groceries, gas, rent, everything was getting more expensive. The American consumer was getting squeezed. The Fed was slow to respond. They called inflation transitory. They kept rates at zero long after it was clear that prices were spiraling out of control. By the time they finally started raising rates in 2020, inflation was already deeply embedded in the economy. Then they raised rates aggressively, from near zero to over 5% in about 18 months. The fastest tightening cycle in modern history. They were trying to catch up, to make up for lost time, to prove they were serious about fighting inflation. And inflation did come down from a peak of over 9% to around 3% today. By that measure, the policy worked. The Fed declared victory. Markets celebrated. Everyone assumed the hard part was over. But here is what they're missing. Here is the mistake that is going to destroy portfolios. The Fed is now cutting rates. They've started an easing cycle, and they're doing it for the wrong reasons. At the wrong time, in the wrong way. Let me explain why this is so dangerous. The Fed has a dual mandate, maximum employment and stable prices. When they cut rates, they're supposed to be responding to one of two situations. Either the economy is weakening and needs stimulus, or inflation is low enough that they can safely ease monetary conditions. Neither of those conditions is clearly present right now. The economy is not weak, unemployment is historically low. Consumer spending remains solid, corporate profits are healthy, GDP growth, while moderating, is still positive. By most measures, we're not in recession and we're not headed for one imminently, and inflation, while lower than its peak, is not back to the Fed's 2% target. It has been stuck around 3%. Some measures show it reaccelerating. The last mile of the inflation fight is proving much harder than the first several miles. So why is the Fed cutting rates? Because they're afraid. They're afraid of causing a recession. They're afraid of being blamed for economic pain. They're afraid of the political pressure that always comes when central bankers tighten policy. This is the mistake. They're prioritizing short-term economic comfort over long-term price stability. They're easing before the job is done. They're repeating the exact error that created the inflation problem in the first place. I've seen this movie before. In the 1970s, the Fed faced a similar situation. Inflation was high. They raised rates. Inflation came down somewhat. Then they cut rates prematurely because the economy was slowing. and inflation came roaring back, worse than before. They had to raise rates even higher eventually, causing a severe recession in the early 1980s. We're setting up for the same pattern: cut too soon, declare victory too early, and watch inflation reignite, then face an even more painful tightening cycle down the road. But here is what makes the current situation even more dangerous than the 1970s. The amount of debt in the system is unprecedented. The federal government is running deficits of $2 trillion per year. That is in a supposedly good economy. Total government debt is over $34 trillion and growing rapidly. Interest payments on that debt are now over $1 trillion annually, more than we spend on defense. Corporate debt is at record levels. Companies loaded up on cheap debt when rates were near zero. Now they have to refinance at much higher rates. Some of them can't handle it. We're already seeing stress in commercial real estate, in private credit, in leveraged loans. Consumer debt is elevated. Credit card balances are at all-time highs. Auto loan delinquencies are rising. Student loan payments have resumed. The American consumer, while still spending, is increasingly stretched. All this debt makes the economy much more sensitive to interest rates than it was in the past. When the Fed raises rates, the impact is amplified by all that leverage. And when the Fed cuts rates prematurely, they're pouring fuel on a debt fire that is already burning too hot. Let me be specific about how this plays out and how it destroys portfolios. First, inflation expectations become unanchored. Right now, people believe the Fed will do whatever it takes to get inflation back to 2%. That belief keeps long-term inflation expectations in check. Businesses don't raise prices too aggressively because they think inflation is temporary. Workers don't demand huge wage increases because they expect price stability. But if the Fed cuts rates while inflation is still above target, that credibility erodes. People start to believe that the Fed cares more about avoiding recession than fighting inflation. Inflation expectations drift higher. Businesses raise prices more aggressively. Workers demand bigger raises. A wage price spiral begins. Once inflation expectations become unanchored, getting them back under control is extremely painful. You need much higher interest rates for much longer. You need a significant recession. The Fed loses control of the narrative, and regaining control requires inflicting economic damage. They're not willing to inflict until it is too late. Second, bond markets revolt. The bond market is the ultimate arbiter of fiscal and monetary credibility. If bond investors believe the Fed isn't serious about inflation, they demand higher yields to compensate for the inflation risk. Long-term interest rates rise even as the Fed cuts short-term rates. We've already seen this happen. The Fed started cutting, but 10-year Treasury yields have actually risen. The bond market is telling you something. It is telling you that investors are worried about inflation and fiscal sustainability. They're demanding a higher risk premium. If this continues, if long-term rates keep rising while the Fed keeps cutting, you get a very ugly scenario. Mortgage rates stay high or go higher, crushing housing. Corporate borrowing costs rise, pressuring profits. The interest expense on government debt explodes, widening deficits further. It becomes a vicious cycle. Third, asset bubbles inflate and then burst violently. Easy money creates bubbles. We've seen this repeatedly throughout history when the Fed keeps rates too low for too long. Investors take excessive risks, they buy overvalued assets, they use leverage, they convince themselves that this time is different. Right now, the stock market is trading at elevated valuations. The S&P 500 is at a price-to-earnings ratio well above historical averages. Some sectors, particularly technology, are at extreme valuations reminiscent of the dot-com bubble. Investors are betting on perfection, on continued earnings growth, on the Fed engineering a soft landing. If the Fed cuts rates and inflation reignites, they'll eventually have to reverse course. They'll have to raise rates again, probably higher than before. And when they do, those bubble valuations will collapse. Stocks could easily fall 30, 40, even 50% from current levels. Fourth, the dollar weakens, amplifying inflation. The US dollar is the world's reserve currency. Its strength depends on faith in American monetary policy. if the Fed is seen as soft on inflation. If foreign investors lose confidence in the purchasing power of dollars, they sell dollars and buy other assets. A weaker dollar makes imports more expensive. Oil, which is priced in dollars globally, becomes more costly for American consumers. Manufactured goods from overseas cost more. This feeds directly into inflation, making the problem worse. We've already seen the dollar weaken from its highs. If the Fed keeps cutting while inflation persists, the dollar could fall much further. That is another inflationary impulse at exactly the wrong time. Fifth, and this is what keeps me up at night, we could face a sovereign debt crisis. The combination of high inflation, rising interest rates, and massive deficits creates a dangerous dynamic. As rates rise, interest expense rises. As interest expense rises, deficits widen. As deficits widen, the government issues more debt. As more debt is issued, rates rise further. This is the debt spiral that has brought down governments throughout history. It is what happened to Britain in the 1970s. It is what happened to Italy in the 1990s. It is what is happening to Japan in slow motion right now. I am not predicting an imminent U.S. debt crisis. The dollar's reserve currency status gives us more rope than other countries. But that rope isn't infinite. And the Fed cutting rates while inflation is elevated and deficits are massive is exactly the kind of policy mistake that accelerates the timeline. So what do you do? How do you protect your portfolio from this Fed mistake? Let me give you specific strategies that I would implement if I were managing money for someone who needed to protect and grow their wealth through this environment. First, reduce exposure to long-duration assets. This includes long-term bonds and growth stocks that are priced for perfection. Long-term bonds are directly hurt by rising long-term interest rates. If the Fed loses inflation credibility and 10-year yields rise from 4% to 6%, a 30-year Treasury bond loses roughly 40% of its value. That is a catastrophic loss for what is supposed to be a safe investment. I would keep fixed income exposure short. Treasury bills, short-term bonds with maturities of 1 to 3 years, you sacrifice some yield, but you protect yourself from the interest rate risk. Growth stocks, particularly unprofitable tech companies trading at absurd valuations, are also vulnerable. These stocks are essentially long-duration assets. Their value depends on cash flows far in the future. When interest rates rise, the present value of those future cash flows falls dramatically. I would shift equity exposure toward value stocks, dividend payers, and companies with pricing power. These businesses can pass inflation through to customers. They're not dependent on low interest rates to justify their valuations. They're defensive in exactly the environment I am describing. Second, own inflation hedges. If inflation reaccelerates, you want assets that benefit from rising prices. Treasury inflation-protected securities, or TIPS, adjust their principal based on inflation. They're designed for exactly this scenario. Yes, their yields are low, but the inflation protection is valuable insurance. Commodities and commodity-related stocks tend to do well during inflationary periods. Energy companies, mining companies, agricultural companies, these businesses own real assets that become more valuable as prices rise. Real estate can be an inflation hedge, though you need to be selective. Properties with short-term leases can raise rents with inflation. Properties locked into long-term leases at fixed rates are vulnerable. Gold has historically been a store of value during periods of monetary instability. I am not a gold bug, but I recognize that gold performs well when confidence in central banks erodes. A modest allocation makes sense as insurance, especially when it seems like markets only go up. But cash has immense option value during periods of volatility. If I am right about the Fed mistake, there will be opportunities to buy quality assets at distressed prices. There will be panic, there will be forced selling. The investors who have cash will be able to take advantage. The investors who are fully invested will be stuck watching from the sidelines, or worse, selling at the bottom to meet margin calls. I would hold at least 15 to 20% of a portfolio in cash or cash equivalents. High-yield savings accounts and money market funds are paying around 4 to 5% right now. That is not a bad return for safety and optionality. Fourth, Hedge your equity exposure. There are ways to protect against downside while maintaining upside exposure. Put options on the S&P 500 or on individual holdings provide insurance against market declines. Yes, they cost money. The premiums reduce your returns if markets stay flat or rise. But if markets crash, the puts pay off handsomely. Think of it as portfolio insurance. Inverse ETFs provide another way to hedge, though they're more suited for tactical trading than long-term hedging due to their daily rebalancing mechanics. Simply reducing equity exposure is the most straightforward hedge. If you are currently 80% in stocks, consider reducing to 60 or 50%. You give up some upside potential in exchange for downside protection. Fifth, diversify internationally. The Fed mistake is primarily a U.S. problem. Other central banks may make different choices. Other economies may be less vulnerable. Developed international markets, particularly those with more disciplined monetary policy, might hold up better than U.S. markets if the dollar weakens and U.S. inflation reaccelerates. Emerging markets are riskier but could benefit from a weaker dollar, which typically supports commodity prices and emerging market assets. I am not suggesting massive international exposure. The U.S. still has the most dynamic economy and the deepest capital markets. But some diversification outside the U.S. makes sense as a hedge against specifically American policy mistakes. Sixth, focus on quality in an environment of rising rates and potential inflation. The margin for error shrinks. Companies with weak balance sheets, unsustainable business models, or unproven profitability get crushed. I would focus on companies with strong competitive advantages, healthy balance sheets, consistent profitability, and management teams with track records of navigating difficult environments. These companies can weather storms. They can even emerge stronger as weaker competitors fail. Avoid speculative investments. Avoid unprofitable tech companies. Avoid heavily leveraged businesses. Avoid anything where the investment thesis depends on continued easy money and low rates. Let me address the counterargument, because I know some of you are thinking it. What if I am wrong? What if the Fed engineers a soft landing? What if inflation keeps falling and the economy stays strong and markets keep rising? It is possible. I don't have a crystal ball. The Fed might get lucky. The economy might be more resilient than I expect. The inflation might truly be defeated. If that happens, the defensive positioning I am recommending will underperform. You'll miss some gains. You'll wish you had been more aggressive. But consider the asymmetry. If I am wrong and markets rise another 10 or 20%, you still make money, just less than you could have if I am right. And markets fall 30 or 40%. You avoid catastrophic losses that could take years to recover from. For someone over 50 or 60, someone who doesn't have decades to recover from a major drawdown, that asymmetry matters enormously. Protecting against the downside is more important than capturing every last bit of upside. This is risk management, not market timing. I am not telling you to sell everything and go to cash. I am telling you to be prudent, to recognize that the risks are elevated, to position your portfolio for an environment where things could get rocky. Let me share some historical context that illustrates why I am so concerned. In 1968, inflation was rising, but the Fed was reluctant to tighten aggressively. They were worried about causing a recession. They were under political pressure. They eased prematurely. The result was a decade of stagflation. Inflation peaked at over 14% in 1980. The stock market went nowhere in real terms for more than a decade. Bonds were devastated. The U.S. economy suffered through multiple recessions. The only thing that finally killed inflation was Paul Volcker's brutal tightening in 1979 through 1982. He raised rates to 20%. He caused the worst recession since the Great Depression. Unemployment hit nearly 11%. It was economically devastating but necessary. We're not yet at 1970, but we're on a path that could lead there if the Fed doesn't maintain its commitment to price stability. Every premature rate cut, every signal that they're willing to tolerate above target inflation, moves us closer to that outcome. I was young during the Volcker era, but I remember it. I remember the economic pain. I remember people losing jobs, losing homes, losing businesses. I remember what it took to restore credibility to American monetary policy. I don't want to go through that again. I don't want you to go through that. And the best way to avoid it is for the Fed to stay the course, to finish the inflation fight, to resist the pressure to ease prematurely. But I am not confident they will. The institutional incentives push toward easing. The political pressure pushes toward easing. The natural human tendency to avoid short-term pain pushes toward easing. Everything about how the Fed operates suggests they will make the mistake I am describing. So I am positioning for it, and I am urging you to position for it too. Let me be clear about one thing. I am not rooting for disaster. I would love to be wrong. I would love for the Fed to thread the needle, for inflation to fall to 2%, for the economy to stay strong, for markets to continue rising. That is the best outcome for everyone. But hope is not a strategy. Prudent investors prepare for multiple scenarios. They don't assume the best case will happen. They protect against the downside while maintaining exposure to the upside. That is what I am doing. That is what I am recommending you do. The next 12 to 24 months are going to be crucial. We're going to learn whether the Fed has the discipline to finish what it started, or whether it is going to repeat the mistakes of the past. We're going to learn whether inflation is truly defeated, or whether it is just waiting to reignite. If you are positioned correctly, you'll be able to navigate whatever comes. If you are positioned incorrectly, overexposed to long-duration assets, underhedged against inflation, too aggressive in your equity allocation, you could suffer losses that take years to recover from. The time to act is now before the consequences of the Fed's mistake become obvious to everyone. By then, it will be too late. Asset prices will have already adjusted. The opportunity to protect yourself will have passed. I've spent my career identifying risks that others overlook and positioning to profit from them. The Fed mistake I am describing is one of the most significant risks I see in today's market. I am taking it seriously. I hope you will too. Protect your portfolio, maintain your purchasing power. Don't let a central bank mistake destroy what you've spent a lifetime building. The warning signs are there. The question is whether you'll heed them. This is not about pessimism or fear. This is about prudence and preparation. The best investors are the ones who survive to invest another day. They don't get wiped out by preventable mistakes. They don't assume that central bankers always know what they're doing. They think for themselves and position accordingly. That is what I've always done. That is what I am doing now. And that is what I recommend you do too. The Fed is making a mistake. Make sure you are not the one who pays for it. Now, let me go deeper on some of these points, because I want you to fully understand the mechanics of what I am describing and how to implement the protection strategies. Let's talk more about why the Fed is institutionally biased toward easing too soon. This isn't about individual Fed officials being stupid or malicious. It is about the incentive structure they operate within. When the Fed tightens policy and causes economic pain, they get blamed. Politicians attack them. The media attacks them. Ordinary people who lose jobs or see their businesses struggle attack them. The Fed becomes the villain. When the Fed eases policy and the economy feels good in the short term, they get praised. Politicians take credit. The media celebrates everyone's happy, at least until the consequences of that easy money show up later. This asymmetry creates a systematic bias toward easier policy. Fed officials are human beings. They don't like being attacked. They want to be praised. Even if they intellectually understand the need for discipline, the constant pressure wears them down. There is also a timing problem. The benefits of easy money show up quickly. Within months, the costs of easy money, inflation, asset bubbles, financial instability take years to materialize. By the time the costs become obvious, the Fed officials who made the decision might have retired. They don't bear the consequences of their mistakes. This is why central bank independence is so important in theory. The idea is that Fed officials, insulated from political pressure, can make unpopular decisions for the long-term good. But in practice, that independence is limited. Fed chairs want to be reappointed. Fed governors want prestigious positions after they leave. The political economy of the Fed creates soft pressure toward accommodation. I've watched this dynamic play out for 30 years. I've seen Fed officials who talk tough about inflation cave when the pressure got intense. I've seen them find excuses to ease just when discipline was most needed. I've become deeply cynical about the Fed's willingness to accept short-term pain for long-term gain. That cynicism is informing my current positioning. I simply don't believe the Fed will stay tough on inflation. If the economy shows any signs of weakness, they'll find an excuse to cut more aggressively. They'll convince themselves that inflation is defeated, even if the data doesn't support that conclusion, and they'll create the conditions for inflation to return. Let me also explain more specifically how this plays out in different asset classes, because understanding the transmission mechanism helps you position correctly, starting with bonds. The bond market is where Fed policy mistakes show up first, and most clearly bond investors are sophisticated. They're looking at the same data the Fed is looking at. When they see the Fed easing prematurely, they price in higher future inflation, which means demanding higher yields today. We've already seen this happen. The Fed cut rates in September of 2024, but 10-year Treasury yields actually rose afterward. That is the bond market saying, "We don't think you are done fighting inflation. We think you are making a mistake. We want more compensation for holding long-term bonds." If the Fed continues cutting while inflation remains elevated, this dynamic intensifies. The yield curve could steepen dramatically, with long-term rates rising even as short-term rates fall. This is a nightmare scenario for anyone holding long-duration bonds. Banks would be particularly vulnerable. Banks typically borrow short and lend long. They fund themselves with deposits and short-term borrowing, then make long-term loans. When the yield curve steepens sharply, especially because of rising long-term rates rather than falling short, term rates, bank balance sheets suffer. We could see another round of bank stress, potentially bank failures for your portfolio. This means avoiding long-term bonds entirely in the current environment. I know financial advisors often recommend a balanced portfolio with significant bond exposure. That advice made sense when interest rates were high and inflation was low. It doesn't make sense now. Keep your fixed income short. Treasury bills, money market funds, short-term bond funds with average durations under 2 years. You'll earn less yield, but you'll preserve capital when long-term rates rise. Moving to stocks. The stock market responds to Fed policy with a lag and through multiple channels. The most direct channel is the discount rate effect. Stock prices theoretically represent the present value of future cash flows. When interest rates rise, the discount rate rises and present values fall. This is why growth stocks, which have cash flows concentrated far in the future, are particularly sensitive to interest rates. The second channel is through the economy. If the Fed's premature easing creates an inflation problem that eventually requires aggressive tightening, the economy will suffer. Corporate earnings will decline, stocks will fall, because the fundamental value of the underlying businesses declines. The third channel is through valuations. When the Fed is easing and investors believe the Fed will support markets, they're willing to pay higher multiples for stocks. When the Fed is tightening or when Fed credibility is questioned, those multiples compress. All three channels point the same direction if I am right about the Fed mistake. Higher rates hurt valuations directly, and eventual recession hurts earnings. Loss of Fed credibility removes the Fed, put that investors have relied on. For your portfolio, this means reducing equity exposure, particularly to expensive growth stocks and speculative names. Shift toward value stocks with low price to earnings ratios. Companies that can maintain earnings even in a difficult economy, and dividend payers that provide income regardless of stock price movements. Real estate is another critical area to understand. Commercial real estate is already in crisis due to the combination of high interest rates and structural changes from remote work. If long-term rates rise further, that crisis intensifies. Office buildings are the most troubled segment. Vacancy rates are at record highs in many cities. Property values have fallen 30 to 50% from their peaks. Landlords are defaulting on loans. Banks are taking losses. This isn't going to get better anytime soon, and higher rates make it worse. Retail real estate faces structural challenges from e-commerce. Multifamily residential has been overbuilt in many markets. Even industrial real estate, which has been strong due to logistics demand, could suffer if the economy weakens. For your portfolio, I would avoid most real estate investment trusts or REITs. In this environment, the exceptions might be certain specialty REITs with unique properties, like cell towers or data centers, that have strong fundamentals regardless of interest rates. But traditional commercial real estate exposure is too risky. Residential real estate is more nuanced. Your home is not an investment, it is a place to live. If you own your home outright or have a fixed-rate mortgage locked in at low rates, you are in good shape, regardless of what happens to the real estate market. But if you are thinking about buying investment property or speculating on residential real estate, I would be very cautious. Mortgage rates remain high. Affordability is stretched. If the Fed mistake leads to even higher long-term rates, housing prices could decline significantly, especially in markets that are already overvalued. Now let me talk about specific sectors and industries that are positioned to benefit or suffer from the scenario I am describing. Energy is a sector I would overweight. Energy companies benefit from inflation because oil and gas prices typically rise during inflationary periods. They have real assets in the ground that maintain value regardless of paper currency fluctuations, and many energy companies have cleaned up their balance sheets after the shale bust of 2015 and 2016. The major integrated oil companies like Exxon and Chevron offer reasonable valuations, strong dividends, and inflation protection. Smaller exploration and production companies offer more upside but more risk. Pipeline companies offer high yields and stable cash flows. Healthcare is another defensive sector. People need healthcare regardless of economic conditions. Healthcare companies have pricing power, and the aging population ensures continued demand growth. I would focus on large pharmaceutical companies, medical device makers, and healthcare services companies with strong competitive positions. Consumer staples are classic defensive holdings. Companies like Procter & Gamble, Coca-Cola, and Walmart sell products that people buy regardless of economic conditions. They have pricing power to pass inflation through to customers. Their stocks tend to hold up during market downturns. Technology is where I would be most cautious. Not all technology, but the high-flying growth stocks, trading at extreme valuations. The Magnificent Seven stocks that have dominated market performance are vulnerable to a reassessment if the Fed's mistake becomes obvious. I am not saying sell all tech, but I would reduce exposure and focus on profitable tech companies with reasonable valuations rather than speculative names. Financial stocks are mixed. Rising interest rates can help bank profitability as their net interest margins expand, but rising credit losses as the economy weakens could offset those gains. And if there is another round of bank stress from commercial real estate or long-duration bond losses, financial stocks could suffer significantly. I would be selective, focusing on the strongest, best capitalized institutions. Let me also address the international dimension in more detail. The Fed's mistake is primarily an American problem, but it has global implications. If the dollar weakens due to lost Fed credibility, that is actually beneficial for international investments held by American investors. When you own foreign stocks, you own assets denominated in foreign currencies. If those currencies strengthen against the dollar, your returns in dollar terms are enhanced. Developed international markets, particularly Europe and Japan, have their own challenges. But if the U.S. experiences a Fed-induced crisis, while those regions maintain more stable policies, their markets could outperform on a relative basis. Emerging markets are higher risk, but could benefit significantly from dollar weakness. Commodity exporting countries would benefit from rising commodity prices. Countries with improving fundamentals and reasonable valuations could attract capital fleeing the U.S. I would consider allocating 10 to 15% of the equity portfolio to international stocks, split between developed and emerging markets. This provides diversification against specifically American policy mistakes while maintaining exposure to global growth. Let me wrap up with a concrete action plan. Here is exactly what I would do if I were positioning a portfolio for the Fed mistake. I've described step 1, assess your current exposure. Look at your portfolio and categorize your holdings. How much is in long-duration bonds? How much is in expensive growth stocks? How much is in cash or short-term safe assets? How much is in inflation hedges? Step 2, reduce your most vulnerable positions. If you have significant exposure to long-term bonds or bond funds with durations over 5 years, reduce that. If you have large positions in unprofitable tech companies or stocks trading at extreme valuations, trim those. Don't try to time it perfectly. Just reduce the risk. Step 3, increase your defensive positions. Build up your cash position to 15 to 20% of the portfolio. Add short-term treasury bills or money market funds. Add tips for inflation protection. Add commodity exposure through energy stocks or commodity ETF. Step 4, rebalance your equity exposure. Shift from growth to value. Shift from speculative to quality. Shift from domestic only to include some international diversification. Focus on dividend payers with strong balance sheets and competitive advantages. Step 5, consider hedging strategies. If you are sophisticated enough to use options, consider buying puts on the S&P 500 as insurance. If you use a financial advisor, discuss hedging strategies with them. Even simple hedges, like reducing equity exposure, accomplish the goal of limiting downside. Step 6, create a watch list. Know what signs would confirm or refute my thesis. Watch inflation data, watch long-term interest rates, watch Fed communications. If inflation reaccelerates, double down on the defensive positioning. If inflation convincingly falls to 2% and the Fed maintains credibility, you can gradually shift back to a more aggressive stance. This isn't a prediction that disaster is imminent. It is a recognition that risks are elevated and prudent investors should be positioned accordingly. The downside of being too defensive if I am wrong is modest. The downside of being too aggressive if I am right is catastrophic. Throughout my career, I've succeeded by managing risk first and seeking returns second. In 2009, I took enormous risk by buying bank stocks. But I did so because I had done the analysis and concluded the risk was worth taking. The expected value was overwhelmingly positive. Today, the expected value calculation points in a different direction. The risks of the Fed mistake I've described are underappreciated by the market. The potential downside is severe. The prudent course is to position defensively while maintaining the ability to take advantage of opportunities that emerge from the turbulence. That is my warning. The Fed is making a mistake. Portfolios are going to get hurt. Make sure yours isn't one of them. The time to act is now before the consequences become obvious to everyone. Protect what you've built, stay disciplined, and be ready for what is coming.